Now let's bring in our next guest, Sam McElroy, a partner with At Financial and At Financial Investments in Chicago, Illinois. Hey, Sam, thank you for joining us today. How's the weather up there?
You know, not too bad, Jeff. It's in the 20s, so, balmy.
Well, it's like 80 degrees here and sunny, and as soon as you feel the Fort Lauderdale sun hit you, it's like getting you can just feel the heat. It's unbelievable how warm it is down here. But listen, enough about the weather. Our show's topic today was really about how to get the right financial professional to help assist you with your retirement plan, how to create income, and how to deal with all the various issues relative to what we go through financially, emotionally, and mentally in retirement. One of the biggest questions we have with advisors that I get, Sam, and I want to know if you get this question too, is people want to know how to create income today. So what's the best and safest way to create income versus the same old Wall Street answer of diversification? How do we create income for retirees today? How do we do that?
Yeah, that's a great question. I think one of the ways that I often explain it to people is that it's not about reinventing the wheel. There's a lot of financial instruments that are already designed to maximize return to people in the form of growth, just like there's a lot of financial instruments that are already designed to maximize return to investors in the form of income. So a lot of times it's just making sure that you align the right type of investment for the purpose for which you're investing. And by doing that, you can often get bigger results without having to take more risks to do so.
Well, what are some of the investment vehicles that we can buy today, Sam, that don't have as much risk that provide income?
Well, if you're looking at the universe of income generating strategies, a lot of it is going to be contractually obligated instruments. So you can talk about some of the visible things that people are already familiar with, like CDs or treasuries or something like that. But then what also lives in that world would be things like individual corporate bonds or preferred stocks, business development companies. In total, there's probably anywhere between 10 to 15 different asset classes that really fall into that world of income generating strategies.
That was a great explanation, Sam. I think one of the things that I see people get confused about is when it comes to bonds, which pay an interest rate, they also get confused about preferred stocks. And people think that preferred stocks, because it has the word stock in it, they're affiliated with the common stock market. But really, preferreds are considered baby bonds because they're very similar in the structure and design as bonds. But they're also uncorrelated to the markets and considered really non-volatile components. So bond and bond-like instruments then are great ways to produce income. Wouldn't you agree?
Yeah, I would say absolutely. At the end of the day, I like that expression of kind of calling preferreds baby bonds. But the idea is that you want the income to have a couple of key characteristics. You want it to be passive because you want to be able to reap off the investment without basically killing or cannibalizing the very asset that produced the return in the first place. And you want it to be renewable. So anytime you have that contractual element, whether it's in a bond or in a preferred or whatever else it might be, it not only gives you stability from an income standpoint, but it helps from a psychological standpoint because you can really count on that income.
Wow, those are all great points, Sam. And you brought out one of my favorite words, cannibalize. And so all too often we see income plans for retirees where they're pulling money out of their savings or through RMDs where they end up cannibalizing the actual principal value of their account because it's not generating enough income. And so bond and bond-like instruments can produce enough income to offset that. And so those are all great opportunities for us to improve our income going down the line here as we retire or we get into retirement. So Sam, tell us in a few seconds, we've got about a minute left here. Tell me what your outlook is going forward for the next 10 years. Warren Buffett says a negative 2% rate of return for the next 10 years. Give me your take in about 30, 40 seconds here on what you feel the markets will do over the next 10 years.
Yeah, I wouldn't disagree with Warren. And people wonder, well, how can that happen? But the thing that we always forget about is that when the market makes a major correction, it usually takes 6 or 7 years or so just to break back even. So if we have a severe enough correction, being negative or neutral for the next 10 years is not out of the realm of possibility.
Well, I agree with you on that basis. There's no doubt about that. Warren Buffett has been very fortuitous about the markets over the course of his market experience his whole life. And so there is a specific reason why he's holding on to so much cash today, because he wants to be able to buy back in the markets when the markets have a correction. And that correction will occur at some point in the future. We just don't know what the catalyst will be or the event. So Sam, don't go away. We'll be back with more right after this break. Now let's bring back in Sam McElroy, a partner with @Financial at @Financial Investments in Chicago, Illinois. Sam, thank you for sticking around. You know, today's a special day in politics. This show is apolitical, meaning that we're neutral. So we're not going to turn it into a political issue today. But today's a great debate day, correct? In Nevada, there's a huge debate. And there's been lots of talk in the markets, and all the major networks have been discussing the impact of what might happen in the fall if Bernie Sanders is the nominee or President Trump gets back and gets reelected. And there's a little bit of a fear factor going on that we see if the potential for socialization and Bernie Sanders wins. And so, as we know, with voters, the voters always do something that's opposite to what the polls say. So we don't know what's going to happen in the fall. So how do we prepare our clients and our client portfolios, or how are we talking to people today in reference to any political risk that might be going on in the near-term future?
Yeah, I think that's a great question. And in a sense, I feel like the reality maybe is almost less important than, let's just say, the psychology of how we perceive the election. You know, I think about when the last administration was taking office, you know, we saw this meteoric surge from November 2016 was it to maybe March of 2017, when the new administration hadn't even taken office and there really wasn't anything that had happened from a policy standpoint. So I think one of the things we have to look at is, regardless of your political affiliation, one thing that we do know is that, you know, quote unquote, Wall Street, in a sense, is very favorable with the current administration. So if things start to change, it's not even a matter necessarily of how the policy is going to impact the economy. The question more is perception of what we think is going to happen, and if that has enough momentum to then start to shift and change things.
Yeah, I think that corporate America is terrified of higher taxes, additional requirements for environmental concerns by way of cap and trade policies on pollution. And CapEx spending might be reduced if we go into, let's say, a socialistic component, because socialism really doesn't work. We've seen that across the world fail time over time again. But yet, for some reason, some part of the Democratic platform, whether it's going to be Sanders or Bloomberg or Biden or Warren or whoever the candidate is going to adopt some type of a socialistic approach in their platform, and that's going to become part of the Democratic message in the fall, which I think economically is not good for the country in the short term and the long term, and it's not good for retirement savings. And so, would you agree with that concern, or do you think that we're being ridiculous in terms of what that concern should be for our clients?
It's hard to tell, because I think a lot of things from a political standpoint are changing relative to the way that they used to be maybe decades ago. In a sense, I think that it's fair enough to say that if you move too close towards socialism, that has ramifications on any, supply-demand based economy. I think that there's just no way around it. Now, whether or not what we're seeing so far in terms of the potential candidates is a true representation of what the party platform will really look like and who ultimately gets the nomination, I don't know if we can make that determination yet. So I think
you're exactly right about that, Sam. We can't. Unfortunately, that's all the time we have today.